Hello, thank you for joining us for today's Tax Insights live session on shareholder exit planning. We're going to talk through various different ways of shareholders exiting a business. And of course, this arises for lots of reasons. So sometimes somebody is retiring, sometimes there's been a disagreement, sometimes business owners just want to go their separate ways for a variety of reasons. And we're going to talk through different ways of shareholders leaving a business, the tax implications, obviously, and then I'm going to give you some examples of really key things that crop up in our day-to-day conversations with our clients around shareholders exiting. So firstly, we're going to talk about a trade sale, because this is obviously very common. Someone decides they no longer want to own their business and they're going to sell it to a third party. So what do we need to think about in terms of tax before that sale happens? And for this reason, one of the things we always talk to clients about is what is your end game? Because if you do want to sell a business, some of the shareholder reliefs have a holding period. So if someone says to us, we might want to sell a business within the next sort of 3 to 5 years, that's great, because that means that we've got plenty of time to put arrangements in place to maximise the tax reliefs on offer at the end. So one of the first things that we might look at when we're talking about a trade sale in the future is transferring shares to a spouse to take advantage of 2 lots of business asset disposal relief allowance. And later on in this session, we're going to talk about the detail of how business asset disposal relief works. But essentially, the scenario here would be you've got an individual who's started a business and they've grown the business, they've done really well, and they might want to sell. So they will only get their own lifetime allowance. Whereas if they transfer some shares to their spouse, which they can do with no capital gains tax between spouses, then the spouse might be able to take advantage of their lifetime allowance as well. So an easy planning point for a future sale. We might need to talk about separating trades into different companies ready for a part sale. So let's say a company has 2 very different trades, one of which they might want to continue with and the other one of which they might want to sell. We need to think about moving those into different companies ready for sale of just a part of the business. We might think about protecting properties by moving them into a holding company. So sometimes a buyer is identified who wants to buy the business, but they don't want the property that goes with it. We've had a few over the last couple of years where there's been an office or a warehouse that isn't big enough for the business, and because it's grown in size. So the buyer doesn't want to buy the building because it's not of use to the business. So we need to move that out. And we might want to look at demerging a company between different shareholders. So let's say, person A is continuing with one part of the business, but person B wants to take part of the business with them or exit completely. We might need to think about demerging a company between different shareholders. Lots of these reliefs rely on either business asset disposal relief, which we've talked about and we'll go into detail on later, which has a 2-year holding period, or the substantial shareholding exemption for companies, which has a 1-year holding period. So you can see that these things really do need to be thought about in advance of a shareholder exit. So when we're thinking about shareholders exiting, if everybody's selling the business, are they going to sell the shares in the company or are they going to sell trade and assets? So the purchasing company can acquire a business either way. It might buy the shares in the company, in which case it will then have a subsidiary, or it might buy the trade and assets out of the target company. And commercially, buyers may prefer the trade and assets purchase, and this is because they can select which assets that they want. They can leave behind assets that they don't want, and they don't take on the trading history of the company. Whereas if the shares are acquired, the whole trading history, any potential tax liabilities, is inherited by the purchaser. And you can see immediately that if, let's say, it transpires later that there's been an error on the VAT returns or something like that, then a buyer wouldn't want to have to take that on. And of course, there are provisions in the share purchase agreement to guard against that and spread that risk fairly. But if a trade and assets are purchased, then there isn't the risk of inheriting the company's liabilities or unforeseen liabilities. But a seller will often prefer a share sale because there are attractive reliefs available to them, whether they're selling as an individual or as a company. And this might actually end up being more tax efficient for them. If a company sells its trade and assets, the money the proceeds go into the company, and then the individual would have to extract them. So often not very tax efficient to have a trading asset sale for sellers. So we often see that sellers prefer a share sale and buyers prefer a trading asset sale. For companies, if a substantial shareholding exemption is available, and broadly speaking, this means that the shares are being sold in a trading company and they have been owned for at least 12 months within the last 6 years, there can be no tax on sale. So you can see immediately that when we're planning shareholder exit in terms of selling the whole business, then the first thing to talk about when the commercial discussions begin is going to be, is it a share sale or is it a trading asset sale? Some key differences are that in a trade sale, the assets are generally brought in to the purchaser's company at the amount paid for each asset, whereas in a share sale, the tax value of the assets is left undisturbed. Secondly, companies might obtain some tax relief for debits related to intangibles purchased from a connected party. The rules have changed several times over the years. Post 2002, but pre 2019, there may have been amortization allowed for intangibles, but since 2019, there's only very limited relief where IP assets are acquired at the same time. But there's no relief at all for amortization of shares if shares are purchased. So there might be tax efficiency for the buyer if the criteria are met, if trading assets are purchased rather than a company. In a share sale, any unutilized trading losses are usually transferred with the company, whereas if the assets are purchased out of a company, then any losses are left behind and extinguished. So potential wastage of trading losses. Degrouping charges may arise. So if a company sells shares in a company where there's been assets transferred on a tax-free basis, then there might be a degrouping charge if that company leaves the group. And then, of course, we have to think about stamp duty. So if we've got shares being transferred, stamp duty is at 0.5%, whereas if a property is being transferred, then it will be stamp duty land tax at the appropriate rate. So we do need to factor that in as well. So the bespoke way a transaction is structured is going to depend on many factors. Part of it will be who has the power in the negotiations, the buyer or the seller. But all of these other tax points that we've just run through briefly will need to be taken into account when finalising the position. And it may be that if a share sale or asset sale is chosen, the other party to whom it's not quite so beneficial might ask for a price adjustment to reflect that. So it's about risk, it's about tax deductions, and it's about price. So we've talked about business asset disposal relief. This is really important when shareholders are exiting, whether they are selling the whole of their business or whether they're just selling a smaller stake. So BAD relief, previously known as entrepreneurs relief, is a capital gains tax relief which allows individuals to pay a lower rate of capital gains tax on the first £1 million of gains in their lifetime. The rate is currently 14%. It's going up to 18% in 2026, but of course we have a budget next week, so we wait to see if there are any changes at that point. Relief applies to qualifying business disposals, which broadly speaking fall into three categories. Firstly, a material disposal of business assets, and this is the one that we most frequently see, and that's the one we're going to talk about today. Secondly, a disposal of trust business assets. And thirdly, associated disposals, which relate to disposals of assets used in the trade but owned personally. So we're going to talk about the first one of those three options today, a material disposal of business assets. So this is going to be one of three things: a disposal of the whole or part of a sole trade or a partnership business, a disposal of an asset used in a business at the time the business ceases to be carried on, or a disposal of shares or securities in a company. So what makes a material disposal for a disposal of shares or securities in a company? Because this is the one we most often see, and the one we're talking about today, because we're talking about shareholder exit, aren't we? So we're talking here about the disposal of shares. So one of 4 conditions needs to be met in order to make it material. Firstly, condition A, in the 2 years leading up to the disposal, the company is the individual's personal company, the trading company or the holding company of a trading group, and the individual is an officer or an employee. We'll talk about what a personal company is in a moment. So the 2 years leading up to the disposal, those criteria have to be met. And one thing that we very, very often see, to be really aware of in terms of speaking to your clients, is that the individual ceases to be an officer or employee. This often happens if there's been a dispute and the individual resigns or is dismissed before they sell their shares. That will mean that they no longer qualify for business asset disposal relief. So if you've got somebody that is leaving a business, really important to talk to them about the timing of when they cease to be an officer or an employee. Condition B, it modifies condition A. It says the company isn't trading anymore, but it was within the last 3 years. So obviously there gives a period after the end of trade when this relief can still be available. Condition C, if the individual holds EMI shares, the personal company requirement that we'll talk about in a moment doesn't apply, but the individual must still have been an officer or employee for at least 2 years, and the option must have been granted at least 2 years prior to the exit. And condition D, again, modifies condition B to apply to EMI shareholdings. Essentially, it's quite niche, but essentially makes that same modification, but for EMI shareholdings. So what is a personal company? So the company is an individual's personal company if their shareholding constitutes at least 5% of the ordinary share capital of the company. It has to be the ordinary share capital. So you have to be really careful here. If people have got preference shares, we really do need to look at the ordinary share capital of the company. And by virtue of that holding, they're beneficially entitled to either 5% entitled to 5% of the voting rights, and either 5% of the profits available for distribution to equity holders and 5% of assets on a winding up, or they have to be entitled to at least 5% of the proceeds on the disposal of all of the ordinary share capital of the company. So it's referred to as the 5% test. People very often say, oh, to get BAD relief, you have to have 5% of the shares in the company, which you do. But it's really important to also look at those. One of the second two must be met as well. The profits and assets test or the sale proceeds test. And in real life, one of the things that very often comes up is when we have growth shares, people aren't entitled to either 5% of the profits in a winding up or 5% of the profits on a sale. For those of you who don't know, growth shares is not a statutory defined term, but the way they usually work is, let's say a founder has built up their business and it's worth £1 million, and then they're bringing in another shareholder. And they say, I don't want to share the first £1 million with you. I just want you to benefit from the growth going forward. So I'm going to change my share capital so that I have the A shares and you have some B shares. And our articles will say that on the sale of a company or on a winding up, I, as the A shareholder, get the first $1 million, and you, as the B shareholder, only get a share of any value above that. So that works very well commercially. It's a very frequent arrangement, but you can see how it might end up such that the B shareholder in that scenario doesn't hold 5% of the assets on a winding up, profits available for equity distribution to equity holders, or 5% of the proceeds on sale. So that's a really key thing to be aware of when people are talking to you about different classes of shares and growth shares, trying to maintain everyone's entitlement to business asset disposal relief. So next, we're going to move on from a trade sale. I'm going to talk about MBO structures, management buyout structures. So I'm sure lots of us have seen these in practice. There are usually 3 different ways it can be structured. Typically, a new company is incorporated by a management team, and then that new company purchases the target. Alternatively, it might be a new co incorporated by the management team which purchases the trade and assets. And we talked earlier about why each of those routes might be preferable to different parties. And the third one, which we sometimes see, is targets trade is moved to a subsidiary and NewCo purchases that subsidiary. So there are three typical ways of doing it. One thing we have to be aware of with the third option is where we talked earlier about the substantial shareholding exemption, where companies sell shares in trading companies and don't pay any tax on them. And we talked about that 12-month holding period. So of course here, if you have a NewCo incorporated, trades move down and then sold, unless 12 months has elapsed, then there won't usually be any substantial shareholding exemption available to the selling company, and it will pay corporation tax on any gain. The substantial shareholding exemption, the SSE, is complicated and there are exceptions, but it would certainly need to be looked at because broadly speaking, if the subsidiary hasn't existed for 12 months, then there won't be any SSE on the sale. So in that scenario, there would be corporation tax payable by the selling company. And then, of course, if the shareholders want to extract the funds, they're going to have to pay tax on a dividend, so potential double tax. There are some other structuring considerations around MBOs. The management team will invest funds into the new structure, which will usually consist of a combination of share capital and loan financing, loan notes. And by owning an equity stake in NewCo, the management team are incentivised because they have skin in the game. They want to grow the company and benefit from future growth when they dispose of those shares. It may be possible to structure it so that the management team benefit from EIS, the Enterprise Investment Scheme, which I'm not going to go into in detail today, but essentially is a very tax efficient way of individuals investing in companies. And so if the structure can be designed such that individuals can benefit from the EIS, that will be very advantageous to them. Additionally, we've talked about business asset disposal relief already. So when we're planning the structure, we'd want to make sure that the management team can benefit from BAD relief on a future sale, if at all possible. The investment made by the management team will usually be supplemented by external funding from banks. And those organisations will often have their own requirements in terms of how the group is structured and the level at which their funds come in. So you might see, quite often see groups of companies and they've got layers and layers and layers of companies in the structure. And that's usually because the bank wants their financing to come in at a certain level. And if there's been refinancing, that can happen over and over again. One key point that's often not considered, but is actually really important in the real world, is that a combination of loan notes and shares will often be issued to investors in an MBO in return for their investment. But an issue that we often see is that rules called the stock stapling rules can apply. And these rules say that where normally a company would expect to get a corporation tax deduction for interest paid on loan notes, if the loan notes and the shares are issued together, they can be deemed to be essentially stapled together, and the loan note is treated as a security, a capital item, rather than a loan. And that would mean that the interest paid on the loan note is not deductible for corporation tax. So you can see that's a potential huge downside for a company thinking it's getting a tax deduction, but then actually discovering that it isn't, because HMRC deem that the loan is essentially stapled to the shares and the treatment has to be the same. In practice, to mitigate this, often we will have two NewCos, one in which the management acquires shares and one which issues the loan notes. So again, really key structuring piece there. In terms of any kind of sale, but including MBOs, there would usually be a tax due diligence exercise, and the tax advisors in that case will be looking at the company, looking at every single aspect of it to make sure that there aren't any unknown potential tax liabilities or risks, and that anything that is discovered is notified to the buyers so that they can decide whether they want to proceed, whether they want some sort of mitigation indemnity or something like that, or whether they want to ask for a price reduction. So due diligence exercise is usually undertaken by tax advisors. key things that very often come out, just to be aware of, in due diligence exercises are IR35 and employment tax issues. So often companies will say they've got consultants, but then when you look at it, actually they are essentially employees in all but name. So HMRC will expect the employment taxes to be collected in the usual way. Shares awarded to individuals, this very, very often comes up in due diligence exercises. So if companies have said to somebody, you know, thank you for your hard work, we're going to give you some shares because you've been such a great employee. Those have to be firstly reported to HMRC. The annual ERS return has to be done for those shares. But also, if the employee doesn't pay full value for the shares, they need to be taxed on the discount they've received. And that's often uncovered in due diligence that wasn't done just because the company wasn't aware of either the reporting obligation or the tax obligation. And then linked to that, if individuals are acquiring shares, it's very normal for them to be asked to sign what's called a Section 431 election. And again, the details of that are beyond the scope of this webinar, but essentially it means that any growth in value will be subject to capital gains tax and not income tax, broadly speaking. It's a very strange system for Section 431 elections because they have to be signed within 14 days of the shares being issued, but they don't actually have to be filed anywhere with HMRC. Those have to be kept and then produced at the appropriate moment, usually on a sale. Very often nobody knew about these elections and they weren't signed, or if they were signed, nobody can find them. So that often comes out on due diligence. So I would say IR35, share awards and Section 431 elections are things to be talking to your clients about if they might want to do any kind of sale or MBO in the future. And in terms of tax advice following the MBO, as well as your tax advisors setting out the steps to actually achieve the MBO, they should also provide you with tax advice for your clients post-transaction. So how does the corporation tax work? When does it have to be paid? What other financing tax issues might affect the new group? So whether it's an MBO or whether it's a trade sale, that tax due diligence and structuring report is really important. We need to know about deductibility of costs incurred during a transaction, the actual fees, professional fees for the transaction. Will the loan note interest that we talked about be deductible? What's the impact of having a bigger group? Is the group going to be pushed into the quarterly instalments regime for tax purposes? Other matters, VAT, stamp taxes, and so on. So lots to be considered and lots to be put into a tax due diligence and structuring report. Moving on now to a different type of shareholder exit. So I did a session on this recently, so I'm not going to go into huge detail on this today, but if you would like the recording, then please do let me know. So selling to an employee ownership trust, where a trade sale isn't on the horizon, and the management team either don't want or can't afford to raise funds for an MBO, owners can have a problem. They want to exit and there's no market. So an employee ownership trust creates a market for shares where one wouldn't exist. And essentially, the employee ownership trust will purchase the shares in the company. This is usually done using a deferred payment mechanism where the shareholder who's exiting will be paid out of the ongoing profits of the company. So if your client is thinking of selling to an EOT, it is important that they're aware of the risk attached to that, because of course if the company doesn't continue to make profits, they might not actually end up receiving their full consideration. So those risks having been pointed out, the advantages are that if everything is structured correctly and it's a qualifying employee ownership trust, then there is no capital gains tax to pay for the shareholders when they sell their shares to the employee ownership trust. On an ongoing basis, tax-free bonuses of up to £3,600 per year can be paid to employees. There is still national insurance to pay, though. It's important to note that it's a tax exemption, but there is still national insurance to pay. And there's been a lot of research which suggests that employee-owned companies have improved performance, lower sickness levels, improved employee retention, improved profitability because of that psychological kind of buy-in. Employees feel they have a slice of the pie, essentially. To qualify for employee ownership trust, the following criteria need to be met. Firstly, the company must be a trading company or the main company of a trading group, which is not suitable for property investment companies, for example. The EOT must acquire and maintain a controlling stake, so it must acquire at least 51%. All employees must benefit on the same terms. Continuing shareholders and other 5% participators who are directors and employees can't make up more than 40% of the employees of the company or the group going forward. And sellers can't have claimed employee ownership trust tax relief in a previous year. So this is a 1 year only thing. So if your client sells 51% of the shares in, let's say, 25-26 and doesn't pay any capital gains tax on them, and then in 26-27 or a future tax year they sell their remaining 49%, they will not benefit from that capital gains tax exemption on the second transfer. It can only happen in 1 year. And this is designed to be a long-term ownership structure. This is not designed for companies to sell to a trust, get these tax reliefs, and then be sold on. So if the company is sold on in the future, the capital gains tax relief will be clawed back. And I went into the detail of how all this works on the previous detailed webinar on EOTs, but whether that's clawed back from the seller or whether it's clawed back from the trustees depends on the timing. But the takeaway is this is supposed to be a long-term structure. But if you would like anything further on EOTs, please do let me know. So another means of company share buyback, shareholder exit planning, is a company share buyback. And this is not really a whole company exit mechanism. This is usually used when an individual wants to exit. Tends to be either because somebody is retiring or because there's been a disagreement and somebody wants to exit the business. So it creates an exit route for shareholders, which doesn't have to be funded by other shareholders as individuals, because the money actually comes from the company. The broad guideline, and we'll go into some detail in a moment, but is that the proceeds to the shareholder are taxed as income, so taxed as a dividend, unless specific criteria for capital treatment are met. HMRC clearance for capital treatment is available. There has to be sufficient cash and distributable reserves because the shares have to be paid for at the time of the repurchase. And there's a very detailed legal process which has to be followed, otherwise the whole transaction is void and treated as never having happened. I've heard of a couple of horror stories really recently, actually, from lawyers that we work with who have been doing a company sale, and it's come out in due diligence that a previous shareholder exit was actually void, and then they've been in the position of having to go back to that shareholder to try and get them to sign documents all over again. But of course, by that point, they know the company's being sold, so they want more money essentially for going along with it. So potential nightmare scenario arising there. So it's really important to get detailed legal advice to make sure it's done correctly. So issues to consider before carrying out a share buyback. As I said, the company has to have sufficient distributable reserves to actually carry out the share repurchase. There has to be sufficient cash because the shares have to be fully paid for in cash. The company has to actually have the power to undertake the buyback. Its articles of association do have to actually permit it, so that should be checked by an experienced lawyer as well, and that tweak might need to be made before anything can be done. There are company law requirements. Various resolutions and various other things have to happen in a very, very detailed and very prescribed way, and if that isn't done, it will be void. So it all has to be planned in advance. It has to be scheduled right. The right documents have to be circulated at the correct times to mean that the whole thing is correctly executed. And we've already talked about the clearance for capital treatment. Post transaction, there are some more requirements. So if capital treatment has been claimed, then the company has to make a report to HMRC within 60 days, letting HMRC know that capital treatment was utilised. You can see already, I mean, so often it crops up that if there's been a dispute, the company remaining shareholders will say, I don't care about the capital treatment of the person who's leaving. I just want them out. But the company, if they're claiming capital treatment, the company does have to actually make a report to HMRC within 60 days. So they do have a requirement, even if they just want the person gone and they're not concerned with the other person's tax treatment. Stamp duty still has to be paid on the repurchase of the shares. That's payable in the normal way at 0.5%. Companies' house filings will need to be made, and all the necessary admin needs to be done. So register of members will need to be updated, and so on and so forth. Purchase of own shares can be a very complex area, so I always seek advice on it before entering into it. So having talked about what needs to be considered in advance, that we'll talk about the criteria for treating the departing shareholder as having received a capital payment rather than an income payment. So the most frequent one we see is condition A. All of these must be fulfilled. Number one, the repurchase must be made wholly or mainly in order to benefit the trade carried on by the company or a subsidiary. So it can't just be for a tax avoidance purpose. Very often, the reason will be the shareholders are at loggerheads. They can no longer work together, so the trade can't thrive and grow unless one person exits. That's quite common. Secondly, essentially saying it can't be for tax avoidance. Basically, it's basically saying that it can't be all designed to enable someone to participate in profits without paying tax on their dividends. The vendor must be resident in the UK in the tax year of the purchase. The vendor must have owned the shares for at least 5 years, or 3 years if they acquired them on the event of somebody else's death. This is probably the one that thwarts capital treatment most times. What we see quite often is 2, 3, 4 people have started a company together, the joint founders, but then after a couple of years they've realised that they don't agree, or sometimes they'll say, so and so wasn't doing any work, or some sort of issue like that has arisen that means that one of them is going to exit. If this happens before the 5-year point, then you can't get capital treatment on a company purchase of own shares. There are alternative ways that we can do it, and that we would do a piece of work to work through alternative structures to essentially exit the person without the company actually buying back its own shares. But that's the one that I would be really conscious of and really talk to your clients about, up front. If they're saying that somebody wants to leave the business, they want to make sure it's capital gains tax. If they haven't had the shares for 5 years, then we need to think about something else. There has to be a substantial reduction in the vendor's shareholding, and there's a very mathematical calculation. Essentially, it has to be they can't have any more than there has to be 75% reduction essentially in their shareholding. And following the buyback, the vendor must not be connected with the company, and broadly speaking, that means they can't have more than 30% of the company. Usually, the person is exiting completely, and that's what we normally see, because it is normally when somebody is leaving completely. Condition B is that substantially the whole of the payment that the shareholder is receiving is going to be made in paying an inheritance tax liability, but that's really uncommon. Usually it's condition A that's the one that is met. So regardless of whether the shareholder is treated as making a capital disposal or receiving an income distribution, HMRC's view is that the company he's not acquired an asset, and so where a loss arises on the purchase of own shares, it's not treated as a connected party loss. Important to note that any fees incurred in a purchase of own shares, professional fees, are treated as capital in nature, so they are disallowable in the company's tax computation, and that's because it relates to the capital structure of the business. So fees must be disallowed. We talked already about issues to be considered after the buyback. I think the main one I would say is don't forget the stamp duty. It quite often happens. So in summary, a purchase of own shares can be a very useful tool, but has to be very carefully planned, and have to make sure that everybody's aware up front of what the tax treatment is going to be for the departing shareholder. And then the final method of shareholder exit we're going to think about is closing the company. So let's say there's no trade buyer on the horizon, and MBOs, EOTs aren't suitable for whatever reason, the individual or individuals might say, we'll just close it down. So there's two ways of doing that. Firstly, informal dissolution. So this is an alternative to the formal liquidation process and is much, much cheaper than appointing a liquidator. So it can be a low-cost, simple way to dissolve a company, but it's usually only tax efficient for those with reserves of less than £25,000. So there are some requirements for an informal winding up. Firstly, a company should ensure it's distributed all the company's assets and property and cash to shareholders. If assets aren't distributed before closing the company and it's dissolved, that property will essentially belong to the Crown. So if this happens, then the company has to be restored in order for the assets to be distributed out. So really important to make sure that everything is distributed first. There are certain things that have to be done in terms of sort of procedural things, which are more of a legal concern. But it's important to note that a company can't apply to be struck off if in the last 3 months it's changed its name, traded or carried on business, or if it's made a disposal of property or rights that it held for the purpose of making a gain in the normal course of business. So you do have to look at what's happened within the last 3 months before you can informally dissolve the company. A distribution by a company is, strictly speaking, income. So it's a dividend, isn't it? We've all seen dividends coming out of companies, and obviously the individual pay income tax on them. But a distribution of share capital, which doesn't exceed £25,000, can be treated as capital in nature. So you can see for small companies, that's very tax efficient. No clearance is required from HMRC. This is usually appropriate when you've had a small business that's been something like a consultancy. Someone's just had a company, they've just done the work themselves, it's a consultancy, and there's not really anything very much left in it towards the end. But if the amount distributed on the dissolution exceeds 25%, the entire amount will be treated as a dividend distribution and taxed at whatever rate is applicable to that individual, bearing in mind their other income. If a company is going to dissolve, the obvious kind of loophole that people would think of is say, that's fine, we'll just pay a dividend out in anticipation of the dissolution, and then we'll get the last £25,000 out as capital. HMRC obviously are aware of this, and if it's deemed to be a dividend in anticipation of a dissolution, then the capital treatment for the £25,000 won't be available. Obviously, there is a question of how you distinguish between a normal dividend and a dividend in anticipation of dissolution. But you can see that the circumstances, it's going to be a case-by-case analysis of the circumstances, just to see if it was a normal dividend or if it was a means of getting more than the intended amount of tax benefit intended by HMRC. We would need to consider the transactions and securities rules here as well. So the transactions and securities rules are anti-avoidance provisions aimed at situations where shareholders have engineered a disposal of shares to get a beneficial rate of tax. We always consider these when we're looking at closed companies, and this is no exception. So we always advise getting advice just to make sure that the share disposal or the mechanism of closing the company isn't going to fall foul of the rules, which are essentially designed to stop people converting income to capital and paying less tax. So if companies owners want to cease to trade, can't sell the company and don't want to do an informal dissolution for any of the reasons that we talked about, a member's voluntary liquidation is the other way forward. So proceeds on a liquidation are treated as capital distributions, which are taxed under the generally lower capital gains tax rates. To pass to undertake an MVL, there would need to be a special resolution, and swear the owner managers would need to swear a declaration of solvency, and at that point a liquidator would be appointed. This is a licensed insolvency practitioner, and they'll realise the assets and pay off liabilities, and any surplus, if there is any, will be returned to the shareholders. So there is a cost attached to that, often about sort of £5,000–6,000, But you can see that if there's much more than the £25,000, obviously the tax benefit of doing an MVL as opposed to an informal dissolution potentially outweigh the cost of a liquidator. And then the final point I'm going to talk about is linking together the business asset disposal relief comments we made earlier to this MVL. So if you're having a member's voluntary liquidation, proceeds are treated as capital. The business asset disposal relief rate of 14% may be available on the first £1 million of gains in a lifetime, providing the criteria we met earlier are met. And just as a reminder, they are that the company must be a trading company, the shareholder must satisfy the personal company requirement, that 5% requirement that we talked about. The shareholder has to be an employee or director of the company or any member of the group. And if the trade has already ceased, the distribution must be made within 3 years of the date of the cessation. So it's really important to time it correctly to maximise the business asset disposal relief available. So that's all that I wanted to talk about in terms of different methods of shareholder exit. We've talked about trade sales, we've talked about MBOs, we've talked about employee ownership trusts, and we've talked about company buybacks of own shares and closing the company. So I hope that was helpful. If anybody has any questions, please do pop them in the chat and I'm happy to answer them. I'll just give you a couple of minutes to do that. If you'd rather not ask a question now, you're very welcome to email me, hello@allegro-tax.com or sarah.gardner@allegro-tax.com, or message me on LinkedIn. I'm always on LinkedIn. Next session is on Wednesday, the 10th of December, EIS common pitfalls and how to avoid them. So I referred briefly earlier to the Enterprise Investment Scheme, which is a really excellent way of companies attracting investors because the scheme offers very good tax relief to individual investors, but it is quite risky. The concept is very simple, but the legislation is very complex and there are lots of pitfalls. So I'm going to go through some of those pitfalls and how they can be avoided. So we haven't got any questions in the chat, so I'm going to end here. Thank you so much for listening. Really appreciate you coming along, and please do get in touch if you have any questions. Thank you.